Pound dollar came under pressure recently in the wake of the Bank of England update. The UK Central Bank kept interest rates and the stimulus package unchanged, meeting expectations, although the bank did caution that inflation could rise above 3%. But at the same time, the Bank of England also said that any increase in inflation is likely to be temporary. This very much echoes the update we've been hearing from the Federal Reserve recently, that inflation pressures are going to be transitory. Sterling took a knock in the wake of the Bank of England update because when traders heard the message that any rise in inflation is going to be temporary, they took that as a sign that the Bank of England isn't in any major rush to go out and tighten monetary policy. At the same time, the Bank of England also upgraded its growth forecast, which is clearly bullish for the British economy. We can see here that the pound versus the dollar has managed to recoup some of the ground that was lost in the wake of the sell-off. While pound dollar continues to hold above this area here at 1.3888, it's likely the recent upward trend and the recent recovery will continue. A move higher from here could see a target 140. Beyond that, we could look to go towards 1.4008, and a move beyond that could see it retest the pre-Fed meeting high in 1.4131. If we do drift lower on pound dollar, we could look to find support from this area here in at 1.3888, and a break below that could see a target at 1.3859. If we do have a break below that, this zone here down at 1.3785, the lows of mid-June are likely to come into play. Pound dollar is also going to be in focus this week because we have the all-important US non-farm payrolls report. It's considered to be one of the most, if not the most important economic announcement of the month. Keep in mind, the last report was mixed, but overall it was positive. The headline figure showed that 559,000 jobs were created, which clearly helps the US labour market. But economists were expecting 650,000 jobs to be created, so there was an element of disappointment. It's also worth noting the unemployment rate fell to 5.8%, its lowest reading since the pandemic struck. So when traders, for the jobs report that's coming out this week, traders are going to be wondering, are we seeing a continuation in the improvement in the US economy? Recently, we've heard from Jerome Powell, the head of the Federal Reserve, and Mr. Powell commented that the US economy is rebounding and recovering nicely, but he also cautioned that the coronavirus crisis still could pose a threat to the economic recovery. Mr. Powell also said in relation to inflation that it's very, very unlikely to return to 1970s style inflation, where inflation in the US was above 10%. Currently, CPI in the US is 5%, which is a 13-year high, but the Federal Reserve don't seem to be too keen to be moving interest rates in the next 6 to 12 months. We've seen a decent increase in the Dow Jones in recent sessions. The US30 has had a nice rebound. It's recovered a large portion, if not all, of the ground that was lost in the wake of the Fed meeting. We can see here that we're now back to levels prior to the Fed update. While the US30 holds above these three simple moving averages, it's likely the rebound is going to continue. A move higher from here could see a target 34,743, and a break beyond that could see a target 34,838. If we do move lower, support could be found from this moving average here. We can see on a few occasions it has acted as support, so there's a possibility it might act as support again in the future. A drop below this moving average could see a test 33,869, or we could see it go as low as 33,745. Gold is also likely to see a lot of volatility in the week ahead on account of the non-farm payrolls report. There tends to be a strong inverse relationship between the gold market and the US dollar. We can see here that gold fell to its lowest level. We can see here that gold fell to a low of 1760 thereabouts last week. It has been recovering for most of the week just gone, but it has managed to drop back below this trend line here. The broader recovery is still intact as long as it holds above this region here in at 1773. A move higher from here could encounter resistance at this trend line. You know, this could be an example of old support acting as new resistance. But if we do manage to retake this trend line, we could look at heading back towards 1797, and a break above that could encounter resistance at 1825. If we do see a drift lower in gold, I might find support yet again at the kind of 1773 area, and a break below that could take us back towards the mid-June low of 1760.